Now, my next guest believes that he's tuned into the physics of the market right now. Here to explain, we've got Rick Bensignor, a chief market strategist at Execution Noble. Rick, also former chief technical strategist at Morgan Stanley.
Okay.
Rick, good to have you with us. So, in looking at some of the earnings that have come out, it seems as though, 85% of the S&P 500 companies that have reported have reported sales and earnings that have exceeded analyst estimates. Now, whether you believe that the bar was set very low or not, that's the case.
Yeah.
So you'd think there'd be some cheering going on. But you've done a little bit of work that says, wait a minute, the actual stock market, if we measure it based on what happened when Alcoa kicked off the earnings quarter, the stock market doesn't seem to be cheering these results.
No, the S&P was 1158 on October 7th when Alcoa kicked things off. We're now at 1182, 1184, something like that. It's about a 2% move. You would think if 85% of companies have beaten estimates, the market would be up a lot more. And I think a lot of this is how much, quote, pre-buying has been done in anticipation of elections, Democrats losing certainly seats, as well as QE2.
QE2, the Federal Reserve going in and spraying the market with some money.
Yes. So a lot of this is kind of baked into the market, and this mid-1180s level in the S&P has continued to repel the advance for about 2 weeks now. And I think it's 12 days ago we went out with clients and said, we think ultimately the market moves higher. But right here, right now, in the 1180s, you actually don't want to do buying. I'd rather wait for a pullback and get something sub 1150, 3% or so down to 5% lower and do some better buying down there, or wait for the market to advance above 1203 in S&P futures, which is probably about 1207 in the S&P cash. Right here in the 1180s, we just don't see a strong reason to do it. And clearly, for at least a few weeks, we've gotten nowhere. Doesn't mean the market's corrected, but it also has not advanced. And with this big news coming next week, what happens if people have it wrong and they've just loaded the boat up looking for this massive move higher, and for whatever reason, I'm not going to prognosticate right now why that might happen or not, but if it doesn't happen, we're going to have a sharp sell-off that'll come quick. At some point, we'll come back and step in. But for those people who are kind of hedge fund type clients that we have, a 5% move is significant. If you're a long-only account, a big mutual fund, 3 to 5% might not be all that significant. But for people kind of trading the market, this is really kind of a key level.
But if the fundamentals of 85% of the companies that have reported so far out of the S&P 500 list have reported well, then the fundamentals no longer matter? What's going on here?
Well, you're asking somebody who looks at the market behaviorally. So I don't typically look at certainly corporate fundamentals. I look at macro fundamentals of the marketplace, but individual corporate fundamentals I don't look at. But there's certainly a feeling going on along the street that less and less just kind of basic fundamental analysis of individual corporate type securities is having less and less meaning. Part of it is because 85% beat. So how accurate are the analysts doing at what they're supposed to be doing? And I won't mention the specific hedge fund, but I can tell you one of the biggest hedge funds in the country, the man who runs the hedge fund has basically told his people about 2 or 3 weeks ago, we really don't care about fundamentals. This is a pure technical / behavioral market right now, and that's all we're really going to focus on. I don't want to hear about earnings. I don't want to hear about somebody beat or missed. It's about the behavior and psychology of the marketplace right now.
Now, you've talked about how important fundamental, or the lack of importance that fundamental analysis has been in this market for a while now. This is not a brand new phenomenon in your thoughts. No. And is this call into question the very sort of validity of using fundamental analysis to determine what to buy or what to sell?
Well, I think in a broad sense, fundamental analysis certainly serves a purpose. You have to have some basis of what a company is worth so you can gauge some theoretical value for the stock. But we also know, looking back 50 and 100 years worth of history, that theoretical value, A, may not be correct, B, could easily have a window 30, 40% on either side of it of where the stock will trade. So you have theoretical value of a company's stock price, and then you have where the marketplace actually prices that. And that's a huge difference. So I wouldn't toss fundamental analysis out the door at all. But I would say you also have to combine it with looking at the stock price itself, how it's moving, essentially technicals, the behavioral aspect of the market, to understand how are players actually buying and selling and viewing that stock within the context of a whole market. So you have macro fundamentals, you have these key drivers of how the markets move over time, but it doesn't have to be short-term trading, but even, look, what is it, 7-8 weeks ago, the S&P was 1,050? Right, that's a 13% move. What's really changed? The only thing is the anticipation of QE2 and possibly Democrats losing seats.
And you say that may be already priced into the market because we don't have this move that would be connected to what companies have actually done.
This hasn't had nothing to do with companies. This has all been this shift in psychology that took place in early September, that the Fed was really going to inject money and kind of save the rear end of the market again.
But what do you make of people who then describe any of the Fed's actions about quantitative easing, adding money to the market, and say, you know what, it's really not going to help the real economy. It's only going to help stocks?
Well, I'm someone in that camp. It'll help somewhat because if you inject cash, it will help, but only to a point. How much can you really expect the economy truly to grow when it's kind of floated on money that is purely injected for the purpose of trying to prop it up and change the psychology of investors behind it?
Well, I guess that's something we're going to have to wait for and see.
If you got 10% unemployment, I know.
We got to go. All right. Thanks very much. Rick Bensignor coming to us from Execution Noble.